Well, good morning, everyone. My name is Mark Lyons. I'm the Director of Sales here at Senior Market Sales, and we have another fabulous webinar for everyone to join into and learn from today. We have our special guests, our friends from Prudential. First off, we have Alan Thorsbachen, and I've known Alan for probably 20 years. And he's our regional vice president. And I would read his bio, but it's really, really long because he's worked there for such a long time. And all I have to say is his interests on his bio are golfing, ice fishing, and coaching his daughter's hockey team. And I'm really hoping that he's a lot better at ice fishing and coaching his daughter's hockey team than he is at playing golf. So welcome, Alan. And also, I'd like to welcome our main feature today, Chuck Peralt. Chuck's the vice president in charge of advanced planning at Prudential, and he will be our presenter today. And our discussion topic is mirrored loans, the basics, and beyond. And I think everyone on the call will find this topic fascinating. Can you just give us a taste, Chuck, before we get started?
Yeah, absolutely. I think this is a problem, policy loans that everybody's come across and hopefully and usually aren't that comfortable with, and hopefully we leave this call feeling a little differently.
All right, great. And Alan, I'm going to ask you, what's the temperature in Minneapolis?
I think it's like 14 below right now, and the feels like is tundra, I believe. So yeah, it's not good here today, but we're managing through it, and it's a good time to be inside and talking about some great opportunities we have. And thanks for the good kickoff there. I've been here for 25 years, but it's Prudential's reaching its 150th anniversary this year, so we're pretty excited to really be where we're at with you guys and with Senior Market Sales and some great partnerships. So we're really looking forward to it. We're really looking to get to $1 billion worth of sales for 150th year this year. So we're doing everything we can. And one of the great ways is Chuck and his team are really helping us out with some really good strategies with mirrored loans and some other stuff that's coming about. I've had done quite a few of these over the last 5, 6 years, and Chuck will talk a little bit about the numbers, but we've really found a good way to find solutions for clients that might be in a bit of a jam with their policies or might be in a little bit of trouble and are trying to avoid a pretty big IRS bill coming up here in April. So with that, Chuck, if you want to introduce Chuck, and we'll kick it off from there.
Well, yeah, I'm gonna let Chuck take it away. We appreciate you guys and Prudential being here, and we'll certainly do whatever we can to help Prudential hit its goal for this year. So we might not, have a huge chunk of that $1 billion, but we'll try to get our little piece of it. So, Chuck, he was an advisor before he started at Prudential 15 years ago, and I think he knows a lot about how all of you on the call are feeling and the questions you have, and so I think this is going to be a really wonderful presentation. This is live, so if you have any questions during the presentation, go ahead and use the Q&A button. It's just if you scroll down at the bottom, you'll see the Q&A, and don't use the chat function because that's disabled for this webinar. All right, Chuck, take it away.
Thanks, Mark. Thanks everyone for taking some time out of your morning here. I promise you'll leave here with a little bit better of an understanding about the opportunity with these types of policies. As Mark mentioned at the top, I started my career as an advisor. I started at MetLife. And some of you maybe relate to this, right? Some of you maybe started your careers at a career agency like I did. And you also can relate to this part, right? I was desperate to get in front of and talk to anybody. So one of the things that they had us do was call orphaned policyholders and review their policies, right? That was a way to go meet people the first time. And And I mean, I need anybody to talk to try and survive in the business. And if somebody had a loan on their policy, I never called them. And I think that's how most people I worked with feel. That's how we've seen most people feel over all the years of talking about this idea. It's that we recognize all the reasons why somebody might need to review their policies, but when we see this loan, maybe you've heard a bad story, or you just haven't heard any story, and you don't realize that there's some there, and there's something that we can do to help these people and put them in a better spot. And it's a shame because there's really so much of this out there, right? We have a list on the screen of just a couple of different carriers and their loan amounts, and this is all public information on these carriers' financial website, and you can see it's a huge number, right? Just these 5 carriers represent $56 billion of policy loans, and there's a heck of a lot more than 5 carriers that are out there today, right? And there's a number of carriers, like I said, I started at MetLife, that certainly still have policies on the books, but and look a lot like these guys, but aren't in the business anymore. So, we won't really ever truly know how many policy loans and how much is out there, but just this little snippet of data would suggest to us that there must be well north of $100 billion of policy loans. So this is a pretty big addressable market and a pretty big problem for a lot of these clients. Yeah, it's an area that most people aren't willing to raise their hand at and say, hey, I'm super comfortable with this, right? So that's the goal that we're trying to get everybody to, right? We want to do that today by going through 3 things. We're going to start by talking about what the issue is overall, and Al mentioned IRS tax bill. We'll get into exactly why that can be a problem. We're then going to talk about how we deal with some cases, and last but not least, we're going to talk about some unique situations where we can use this idea maybe a little bit differently than you might see for the first couple of parts of the presentation. So what's the issue? Well, let's start by talking about the problem. There's 2 ways that a loan can end up on the policy, and the first way is the obvious one, right? If you've ever put a policy with cash value in front of a client, you probably told them that if they ever needed it, it was there. And some of them needed it. The second thing, though, is unique to whole life, which is on a whole life policy, the premium is generally required to be paid every single year. And if those premiums are not paid, those premiums automatically loan themselves out of the contract. So it would stand to reason there's probably more loans on whole life contract than any other type of contract, which is why you saw on the earlier slide predominantly whole life companies on that list. Now, the long-term problems that a loan can cause, some are obvious and some are not. The first is obviously if you have a loan, you're accruing interest. If you don't pay it, it'll keep growing. And if you wish to maintain your coverage, these loans may be detrimental, right? If you miss a bunch of premiums and accrue a bunch of interest, and 10 years later you say, I want to keep this coverage, well, your cost to do so is going to go up, right? You have to make up for the fact that we borrowed money and borrowed interest. Now, some people will do that and say, hey, you know what? I actually don't care if my policy lapses. I'm retired, I'm a little older, I don't work. No one relies on this in the way that they used to. The problem then becomes is that if a policy lapses with a loan against it, that loan is taxable to the extent of the gain in the contract. So that's that IRS bill Al mentioned earlier, right? You end up in this situation where these clients are kind of damned if they do and damned if they don't. If they want to keep their coverage, the cost has gone up pretty significantly. And if they don't wish to keep their coverage, that policy will lapse and they will owe a big tax bill to the IRS. So we call it phantom income. You owe a bunch of income tax, but you didn't actually get any money when that happened. So this is kind of the problem, right? And a lot of times people just try and ignore this problem, and I guess hope it goes away. I mean, hoping it goes away means hope you die before before you owe too much money or you get this problem. I mean, depending on how old you are, that might be a strategy, but for a lot of people, that's not going to be a real good strategy. So we try and go through every case as the client has 3 options, right? First is do nothing, right? Keep what you have. You don't have to address this problem. What that might mean is you're going to owe taxes down the road, so you should be aware of it, but you should at least consider what that option looks like as one of your 3 options. You might not like it, but you can certainly pick it. You could change your approach, right? You could just somehow fix your old policy. If you call up the carrier where your policy is and you say, what's it going to take to keep it in force? They'll tell you. You might not like the answer, but they'll give you an answer, right? They'll send you that data. Where we've seen our success is to do a 1035 exchange to a new policy and bring that loan as part of the exchange over to the new policy. And there's a couple of reasons why this tends to work out better than keeping what they have. The first is our contracts have really low, fully guaranteed interest rates. For the most part, our loan interest rates are 2% for the first 10 years that drop to 1.05 in year 11. And I only say for the most part, is eventually that will be the case on all of our products. There's just a couple that haven't gone back and made this change to during our reprice yet. So to start off, right, that's a much lower interest rate than we typically see on what the client has. It's very common to see 6, 7, 8% loan interest rates. Not surprisingly, going to 2, that drops to 1 is going to provide them a little bit of relief. The biggest thing, though, is the first bullet, which is you get to redesign that contract to meet today's needs. Most of our clients, when they bought their policy, did not see a version of that illustration that said, what happens if I miss a bunch of premiums, the dividend changes, and I borrow money unexpectedly to fix my roof, right? They didn't see that. They probably shouldn't have seen it because they couldn't have possibly anticipated that exact sequence of events. But it would stand to reason if your other contract, your existing contract, never anticipated the situation that you're in. And that if we can design a contract that entirely anticipates the situation that you're in and the problem that you're having, we should have at least some chance of doing a better job of solving that problem. And that's what we find, right? And this is true of any 1035. You're very rarely doing a 1035 and doing exactly the same thing as they were doing before. You're doing something different to better fit their current situation here today, solve today's problem. We're going to do exactly the same thing here. There's just that added element of the loan that has to be dealt with. Now, the 7702 changes a few years back were actually a real good guy for us. And you might say, well, Chuck, I heard people talk about this. And when they were talking about this change, they talked about LERP sales, those kind of max funded, max income type of sale. That's the kind of conversation I've heard around these changes. And that really was the topic. But for these cases, it actually did a couple really nice things. The main thing it lets us do is buy less face amount per dollar of 1035. And you might say, well, Chuck, I've never done that. We never try and buy the least death benefit a client could buy. We're always trying to buy the most death benefit a client could buy. But in these cases, being able to buy less death benefit means we can take 1035s with more highly loaned policies than we ever could in the past. So today we can take cases north of 90% of the policy value being loaned out. Prior to these changes, that number was maybe more like in the low 80s. So there's really a whole swath of policies that we can look at today that we couldn't have looked at in the past, which segues nicely into what are our rules? Because that's the question we always get, right? So tell us more about
Chuck, do you mind if I interrupt? Could you explain a little bit more on the 7702 impact on Prudential being able to take more policies with loans?
Yeah, so there are a bunch of different IRS calculations about, MEC limits and definition of life insurance and all things that you've all likely heard before, right? And you sort of know they exist more than you really know how they are arrived at, right? And frankly, that's probably the extent that any of us would ever care, right? They exist. We don't even know how to do the math, and the software will do it for us. So after these changes, those calculations changed. So effectively, there was an interest rate calculation that changed to reflect today's interest rate environment. And that calculation lets us buy meaningfully less death benefit per dollar of premium, and in this case, 1035s. So in the past, maybe you would have bought $500,000. That was your minimum. That number now might be like 250 or 300,000. So it's obviously a pretty big difference, but the way it manifests itself in these cases is that for any case with a loan, you have to have a positive surrender value. can't be zero. It certainly can't be negative, right? You have to have a positive surrender value. Well, the larger the 1035, the larger the surrender charges are on those contracts. So the smaller, the inverse of that's also true. So smaller 1035s, smaller surrender charge period, smaller upfront cost, of course, too, because we're buying this death benefit. And that allowed us to pretty meaningfully increase how much loan we could take. So, so what are our rules? We have one rule, but it kind of has two parts. The primary rule is that you have to have at least $25,000 that is not loaned out. Now, that's pretty easy, right? Pretty easy to understand at least. But you may have noticed that I said at least. So I said at least because as the 1035s get bigger, 25,000 may not be enough. So if you have a $10 million exchange and you only have $25,000 that's not loaned out, you have well under 1% of the policy's value not being loaned out. You literally don't have enough left in the old contract to put a new contract in force. So when we're looking at larger exchanges, that's the question, is literally, do we have enough to put the new contract in force? And somewhere around 90% of the value being loaned out is where that kind of theoretical maximum is. Maybe a little bit more, maybe a little bit less, depending on the exact client and underwriting and product, of course. But somewhere around that range as they get bigger. So you always need at least 25,000, but in some cases you will need more. We can do this on any of our products. As you might expect, some products work better than other products. So that being said, we will try and pair it up with whatever your goal is, right? You let us know what you're hoping for. We will try and figure out what the best product is to hit that goal. And if we think another product will work better for you, then we'll make that recommendation. But as a start, nothing is off the table. But certainly not every product is going to work equally well for these kind of cases. And last but not least, before we dig into the cases, I want to share some of our results. And this is actually a little bit old. This is prior to last year. We have last year's numbers now. It's something like 2,800 of these cases that we've placed. We're somewhere closer to $1 billion of 1035 wood loans. And I couldn't even possibly tell you how many of these policies my team and our internal team have reviewed at this point. And I share that with you not because I think you care about how much business Pru is doing, but I do think you should care about how many of these we've seen and worked on in our experience with them. You don't care how much we've done in sales for these, but you do care that you're getting the right answer and the best illustration and the best conversation for your clients, right? This is not a side business that one person does off the side of their desk part-time for us, right? We have real resources. We have a lot of people that know how to work on these cases and have these conversations. And I think that's important because these aren't set it and forget it and just send out an illustration and you're going to know every part of what they have and what's going on in cases, right? Things you guys do every day, it may be that easy, right? You may have done it enough times that it's straightforward to you. For these, a lot of times there's conversations that we're involved with, helping explain what the clients have, how it's going to work, why it works, what we're doing, how it's working, right? And all of that is really important because if you're not confident in the solution, then your client's not going to be confident in you when you get out there and have those conversations. So we're happy to get on calls with you guys and gals, spend as much time as you need to understand exactly what we're showing, why we're showing it, and how it all works. Because at the end of the day, you guys have the hard job, right? You actually have to explain this to the client. I just have to explain it to a bunch of guys who know a little bit about life insurance. So let's talk about the cases. So I tend to break cases down by how loaned out they are. All right, that's really the biggest indicator of kind of where that case is going to go, because they all kind of loosely fit the parameters you'll see here on the screen. So let's start with cases that are not that loaned out. So when I say cases that are not that loaned out, that's cases where less than half of the value is loaned out. Usually the way we got there is they missed some premiums and just got on auto premium loan. You know, maybe they had a small or a reasonable unexpected bill. But these aren't keeping people up at night, right? Your policy's not going to lapse because 20% of the value is loaned out. It might lapse eventually, right? Down the road, you might have some problems if you start doing that. But there's not a lot of urgency here that we're trying to tackle, and that's okay, right? That's true of most policy reviews that you do. It's not urgent that they replace it or see if there's opportunities. It's just sometimes we should see. So for these types of cases, I want to know and do everything that you want to know and do on any other policy review, right? What's the client's goal? What are they trying to do? Is there a premium? Is there a death benefit? Are we looking for a rider, right? Anything you might normally think to ask, I want to know that too. The difference is with these cases, what we do with the loan, because the whole purpose of this conversation is to have that policy loan be in a better spot. Most of the time when the loan is less than half of the value, there's significant cost basis in those contracts. And we can actually take a withdrawal of cost basis in the second year of the policy and use that withdrawal to repay the loan on the contract. And that can be a real appealing scenario for the client because they're using the funds inside of their contract to get rid of the loan, right? Which means they're not using their own funds. So that design is something we see all of the time because clients really like that idea, right? They really like, I can get rid of this loan that I a lot of times don't feel like I took because all I did was not pay my premiums. I can get rid of this loan without actually writing a check to do so. That's both a good conversation at the point of sale with the client and also just something that's going to help relieve these down the road, right? If you no longer have a loan, all the concerns we've been discussing go away. Now, the question you might ask is, well, why couldn't they have done that on their old contract? And the answer is the word that often scares people away from anything with the loan, which is boot. Now, most folks don't know what boot means. They just know that it's a thing that can happen and it can cause taxes. And then causing taxes unexpectedly is a bunch of words that in a row that don't work well in our business, right? What boot is when a client receives some value outside of what was anticipated from the 1035 exchange. So all right, you said I tried to make that as English as possible, but it's just not that English. So let me give you a couple of examples. If you do a 1035 and you choose not to bring the loan over to the new contract, you can absolutely do that. In some cases you should do that. But if you do not bring the loan over to the new contract, the old company doesn't care, right? They'll keep their collateral from the policy. They'll keep their money, and the new company certainly doesn't care what you used to have. But the IRS says, well, in addition to all those tax benefits of the 1035 that you got relieved of debt because you no longer owe this loan. So we're going to tax that as boot because you got something extra as part of that transaction. Okay, fair enough, right? It's pretty clear. So still though, why couldn't they take that withdrawal? Well, the withdrawals have the same problem. If you take a withdrawal shortly before within close proximity to the exchange, and I use those terms close proximity because that's what the IRS uses. The IRS can say, well, this is actually just one big transaction, not two separate transactions. So we're going to tax that withdrawal as if as boot, and again, that makes it taxable as well. So you might have been able to do this with your old contract, but if you are going to do a 1035 exchange anyway, and a lot of times you want to because better death benefit, premium, a rider, whatever, you don't want this to happen. So this is never something that should happen by accident, right? But it's something that sometimes people don't necessarily understand their rules, and client gets the wrong guidance.
Is there any reporting that goes to the IRS if that withdrawal takes place shortly before the exchange?
Maybe.
Maybe.
So
Yeah.
because the
So-
IRS's definition is vague, right? The IRS's definition is close proximity. Well, what does that mean? Well, it would stand to reason, I think, that if you took a withdrawal today and 1035 did tomorrow, that's close proximity. It'd be really hard for me to argue that that's not by any definition of the word. But when does it stop? Is it a month, a year? And most people say if you're doing things in different tax years, you're probably okay with it. But if you did it December 31st and January 1st, would they be okay with that? I don't know, right? So some companies have put out their stance, most have not. And so it's kind of a grab bag of are they going to report it? But here's the thing, I'd rather not guess. And ultimately, if it makes sense to do this, and you're going to do the exchange anyway, then just don't risk it. Just do it on the new contract, and why have any of these discussions, right?
Yeah.
There are times where somebody, it might make sense to pay a small amount of taxes, and we have that conversation, and they know it up front. I think that's okay, right? If they agree, they know what's going on, they get it, they know they're gonna get a tax bill, full disclosure, right? All good. But if we're guessing and we don't know and maybes, that's a bad territory to stay with. And ultimately, if we're going to do the exchange anyway, or keep your old policy anyway, there's just no need to take that risk, in my opinion. I wouldn't do it.
All right. All right. Thanks, Chuck.
So the other area where I spend a lot of my time, really more so than the other ones, are the policies that are more highly loaned. So for me, that's policies north of 75% of the value being loaned out. Now, these policies usually are going to lapse. Maybe not tomorrow, maybe tomorrow if they're that loaned out. But a contract north of 75% loaned out is almost certainly going to lapse at some point, and the question just becomes: is that point 101 or 71, right? And or where in between? And the real concern there is certainly the loss of coverage, but more importantly for a lot of people, it's that tax bill. And a lot of times, as we talked about earlier, to keep that old policy in force, the cost is really high because the interest rates are really high. It's also a challenge for you as an agent because most companies have some kind of rule of how loaned out a policy they can take. So there's not necessarily that many homes for policies that are really highly loaned out in terms of new coverage. Now, most of the time when we see these cases, the goal is the same, which is I just don't want to pay this tax bill, right? How do I not do that? And it becomes pay the minimum, try and make sure that doesn't happen safely and comfortably for the client, right? Ultimately, the goal is for the client to die, because if they die with the contract in force, the loan will get repaid out of their death benefit. That would not be taxable, and their family will get whatever is left. So death really is the strategy here. It's just designing a contract that will get them there can be the tricky part. Fortunately for us, because of those low interest rates, it's usually pretty easy for us to design. If you bring it over and pay the interest, which is 2% for years 1 to 10, and 1.05 thereafter, most of the time that's actually enough to keep these contracts in force, and most of the time that's a lot less than what they had in their old contract to keep in force. So if it becomes a question of pay a big tax bill or put money towards your policy, it's usually a relatively easy choice for the client, unless those numbers are pretty out of line from one another.
Hey Chuck, what do you typically see for interest rates from some of the whole life companies and stuff? What a lot of these people already have on their policies with the loans they have?
It's really common to see like 8% fixed loan interest rates. Some companies are variable, so those have ticked a little bit lower, but they're still usually like 5, 6. We don't see a whole lot less than that, and a lot of them are just fixed 6, 7, 8% loan interest rates. So it's very rare that we see. I don't think I've ever seen anything at 2 or 1 like we're going to ultimately try and put them at. So what do we need for a proposal? Well, we need a lot of the stuff you'd think we need, right? We need the client information, surrender value, the loan amount. We need the cost basis. The cost basis is really important because if we're going to take a withdrawal and use that to repay the loan, we need to know the cost basis to make sure there's no taxes. If you have a highly loaned policy and you're going to say, hey, Mr. and Mrs. Client, this is better than paying your taxes, you need the cost basis to know what their tax bill is going to be, right? So we're not difficult to work with, right? If you're gathering information and just want to see if there's something there, we can make some assumptions early on to try and get you a ledger to evaluate, but ultimately it's really critical that we have that information accurate. somewhere before we go do the 1035, and preferably at day one, but I get that it's not always that easy. We don't need an in-force ledger, but it's super helpful, especially if you've not done one of these before. I've seen an in-force from just about everybody and every product at this point, I think. So we're really used to looking at them. A lot of times they can be tricky, and people don't know what they're looking at. So while we don't need one to run these, it's really helpful if you have one. And ultimately, if you're replacing the client's policy, you probably should have gotten an in-force on that anyway. And last but not least, what's the goal? What are you hoping for? And I don't mean to make it that simple, but I get so many requests of, here's the numbers. What is there anything you can do? Yes, there's always something we can do, but whether I can do what you want or not, I don't know unless you give us some idea of what you're hoping for. So, pay the minimum, avoid taxes. Those are goals, right? And I can assume based on what I'm looking at, what the client's probably going to want, but every now and then, somebody will send something back and say, hey, well, they really wanted 10 million of death benefit or whatever. I'm like, well, would have been great information to have up front, right? So I know it sounds kind of silly, but it's something that we really need. We do have a way to help you explain this to your client too. So every time we run one of these, there's a report that populates the first couple of pages of the illustration that really walks through the same type of stuff you've seen here today, right? It goes through some of the tax issues in relatively plain English for clients to understand it, and maybe most importantly for all of you, there's a customized ledger in there that details, in my opinion, everything that you should and would want to know with these types of cases. And we do have Life Insight. So Life Insight is our in-force policy management tool. And the real important thing here is it will tell you what kind of actions are expected to be taken and whether or not they have happened. A lot of these cases are not set it and forget it. Some are, some aren't. But usually, maybe if we're taking a withdrawal to repay the loan, that is an action that has to be taken. That's not automatic. It's easy to do. It's one form, but you do have to get that form completed. So Life Insight is our policy management tool. You can go in there and you can say, hey, we were supposed to do that this year. Did it happen? If not, let's make it happen, and it'll help us monitor it. So it really is a wonderful tool for any in-force policy review, but really important for these types of cases to help monitor the actions. So last but not least, I'm going to run quickly through a few bonus ideas here that have to do with policy loans as well, and then we'll wrap up. First is loaned out MEC'd policies. You don't see a lot of these. When you do, they're a disaster. Most of us are familiar with the MEC rules, right? Your gain comes out first before your basis, but you're probably not that familiar with how they work with loans. Now, if you take a loan from a MEC'd policy, the IRS says, hey, we're thinking that you're trying to get around our rules, so the loan was going to get taxed just like it was a withdrawal. So you can't just like make your contract to MEC and loan out all the money and avoid all the negative consequences. The MEC rules prevent that, or well, they don't prevent it, they make it cause taxes. Really interestingly though, is if you accrue interest, which means you already have a loan and you just simply don't pay the interest bill, that's as if you took another loan, and that accrual of interest itself is taxable every year. So when you see these, often the biggest thing that matters is just what's the loan interest rate. Al and I worked on one of these a couple of years back where it was an 8% interest rate, and they either had to pay 8% or pay the taxes on not paying 8%. Well, we brought them over where the loan interest rate was 2%, and obviously right away it was a 75% relief in their outlay. It was less to pay the interest on our contract than to pay the taxes on not paying the interest on their contract. And there's other things that go into it, right? The death benefit and everything still had to make sense. But for some people, the biggest concern is literally just what am I spending? And we can provide relief on some of those.
Out of curiosity, what have you guys seen as far as why there's a MEC policy in the first place? I mean, was it an accident? Was it on purpose?
It's always an accident, right? It's almost always an accident. It's just people not knowing what the rules were, and I'm sure most of you on the call can appreciate this. Like usually the clients do stuff and they don't usually call their advisor, right? They just think they know, they think they remember the conversation, right? They do something, and if you make your contract a MEC here, we assume it was probably not on purpose, and we send you a letter saying, hey, are you sure? I think most carriers do that. But does the client read it? I don't know. I mean, they should. It'd be great if they did. That's why we send it. But I think it's truly just people not paying enough attention, and advisors aren't in the picture anymore on a lot of these as well to even pay attention if they were there. And even if they were, how many people know how MECs and loans work together, right?
Right.
It's relatively uncommon. So you're not going to find a ton of these. But if you do, it's just a home run of an opportunity, because sometimes the only thing they care about is how much they're spending. And literally the only way to do that is to reduce that loan interest rate. Now, the next two kind of pair together, so I'm going to kind of present them as one. Some people, instead of taking a loan from their policy, will take a loan from a bank and use their policy as collateral. This actually made a lot of sense over the past decade or so, because those contract loan interest rates are often high and fixed. And there were banks who would lend you money and use your policy as collateral at low interest rates. The other great thing about that, if you were doing it, is if you have a loan against your policy, that can affect the performance. Well, if you have a loan at the bank and your policy is just the collateral, well, then your policy performance is totally unaffected. It may have been a good idea for people to do this instead of taking a loan from their actual policy. However, those loans are almost all variable loan interest rates, which means they're now 400 or 500 basis points higher than they were a couple of years ago. So something may have been a good idea, but at the very least, with these interest rate changes, might not be anymore and should be evaluated. Well, this is also a lot like premium finance. In premium finance, they borrow money to pay their premiums. The end result is pretty much the same. You have a policy with a lot of cash, where that cash value is collaterally assigned to a bank. The problem is the same as if the loan was on the policy itself. Your interest rate is now high, and you either pay those higher costs, which is not appealing. You can surrender your policy to pay back the lender, but you would cause all of the gain to become due. Or you could take a loan from your policy to repay that lender. And then you're in exactly the same situation that we've been talking about for the last half hour. So if you come across these, and again, I know this is not necessarily a market that everybody is in either of these cases, but at the very least, these should be reviewed with your clients, because these interest rates have changed really dramatically, and those economics of these deals are going to be impacted, and it may not make sense anymore. Last idea, and then we'll wrap up. Somebody with too much cash in their policy, and you guys are like, "What? How is that? That's not a thing," right? Too much cash in their policy is not a problem per se, but it sometimes puts yourself in a weird situation to plan for a husband and a couple. So in this case, we had a 65-year-old couple, right? And you guys have probably seen this before. One spouse, usually the husband who was working, and usually not a non-working spouse, has a policy that has a lot of cash, right? Somebody has a big policy with cash, the other one maybe never had insurance or doesn't have anywhere near the same amount of cash. And now they're both retiring, and they just want to get a policy with chronic illness, right? Whatever that death benefit is. Well, how do you do that? Super easy for the one with the cash value, right? You just do a 1035. Not that easy for the one without the cash value, right? Because you can't take the money you can't split the 1035 to a different insured. It doesn't work. So if you're dealing with situations like this where someone's entering retirement, they don't want new costs. They want to leverage what they have to pay for their costs. So could you surrender the husband's policy and then split the money between his and the wife's? You could, but that potentially makes the new ones max, potentially causes that taxable gain. Could you withdraw from the husband's policy and use that money to pay for the wife's policy? Could, but we talked about that earlier. That can cause taxes. So what we actually do here sometimes is take a loan. So we take a loan from the husband's policy, use that loan to pay the premium for the wife's policy. And then what we talked about earlier, when the loan was less than half the value, use that basis to repay the loan on the husband's policy. So what we're doing here is creatively using policy loans to split a 1035 in a scenario like this, where they don't both necessarily have 1035 money to fund their new contract.
No, that's very clever. That's very clever.
So, we don't see this all the time, right? But I try and give you guys all these bonus ideas at the end because there's a lot of kind of loan adjacent ideas that we can use when it's not necessarily just the traditional policy loan, where a lot of the things we're talking about can still be used as solutions. So, what do we talk about today? So we spent some time talking about what the issue is. We went in through some of the case exploration and through a few bonus ideas here at the end. So how can we help? Right, I think you guys have probably heard and know the Prudential story, but I think the most important thing that we can help you with is our experience. We've seen so many of these cases, and we're not the only carrier out there that can do these, though we are the only one that can do some of them. But we've done it before. What we've seen, even in our own people, is people will try and help and run these ledgers, and they just don't know how all these moving parts fit together. And you get a really well-intentioned person trying to help, and you don't get the right information. I see it all the time. On our end, we really limit who can work on these cases because they're important to us. They need to be done correctly. And what we don't want is somebody trying to be helpful turning into someone getting the wrong guidance. So we have put a lot of controls and training in around this idea because we know it's super important that you guys have the right information to your client the first time. We have a lot of marketing material around this. We have broker approved stuff, client approved stuff. We have 1035 FAQs, and we have literally everything at this point to try and have that conversation. But I always will wrap up with this. This is my favorite idea because of the first bullet point here. If we were to do this in a room together, I have everybody raise their hand if they've ever come across a policy with a loan. Everybody raises their hand. We've all done it. And if I asked everybody to keep their hand raised and they said, are you comfortable working on a policy with a loan? Do you know what you can and can't do? Every now and then you get a brave soul, but for the most part, none of those hands stay up, which tells us that you guys have these clients, you've worked with them, they maybe are even in your book of business, and we're just not comfortable, or we didn't know that there was any opportunity to solve these problems. So this is my favorite idea more than any advanced planning idea that we talk about, because it's the one I'm most confident that you've all come across and already have clients who have this exact problem. So that's what our ask would be at the end, right? If you took the time to sit through this, hopefully it's because you thought of someone or had someone in mind that has this issue that you were concerned with. Work with Mark, work with his team, he'll work with us, and let's take a look at those cases and see if there's something that we can do to put these clients in a better situation.
Yeah, thank you for that, Chuck. Can you just take a minute to explain the impact of age and health risk? I mean, people presumably are, some number of years older and possibly some degree less healthy than when they took out that original policy. And does it have an effect, really?
Sure, it always matters, right? They have to get through underwriting in some way, shape, or form. But think of the demographic of people that we're talking about, right? For this to be your problem, you must have had a permanent policy of some size for some length of time. Well, that's very rarely a 22-year-old, right? Most of the people we look at are 50s, 60s, and 70s. So, obviously we've had lost cases due to underwriting for sure. That's a thing that happens at any age, but it doesn't always have as much impact as you would think. So certainly they need to get through, but like on a more highly loaned one, Mark, where we're trying to just minimize the death benefit and try and avoid that tax bill. Well, if we're not actually buying that much net death benefit, the fact that each unit of death benefit is a little more expensive because you got a table B instead of a preferred best is not as impactful. It's impactful, but it's maybe not as impactful as some of you are used to on sort of a more traditional life insurance case. So, our average client for these is like 68 years old, according to our data. So somewhere in that ballpark. So, I mean, certainly it's a concern, but enough of them are able to get through that without an issue that this is a place where we spend a ton of our time.
All right. That's very good. Thank you, Chuck, for taking, somewhat complex ideas, or maybe to some folks on the call, very complex ideas, and making them making them simple. And I think the message has been heard loud and clear that everybody has the ability to run across these cases, and and if we get them to the SMS team and then to Prue, we'll be able to possibly and probably help the client out. So that's a good takeaway. Alan, is there anything you want to add?
No, I think Chuck covered it very well. I mean, like I said, we have some pretty exciting things coming up here with year 150 here with Prue. One of them is our Momentum IUL fixed IUL product that we got out right now that works really well with these loan rescue cases. It's a newer product for us. It's got a 1-year S&P point to point, a 6-month S&P point to point, and then it's also got a 1-year NASDAQ point to point. And again, it's priced really well. So when you kind of ask that question at the end there, what's the difference between an older whole life that you've had for a while? Obviously, a lot of it comes down to policy costs. So you may be a little bit more to insure, but the policy cost may be less than the new contract you're pulling over to. So, and again, when you do these types of situations, commissions are based on the gross coming over, not the net. It's often a big trigger here, Prudential, to look through. And like I said, Chuck and I have done quite a few of these together. We've looked at a lot of them. The best part too is you talk about the Prue designs, and on the second page, it really does literally walk your client right through the do nothing, do something, or do something over a Prue. So it's a really great, easy way to show your client their scenario, and it is customized to them. So when we run, send it over to you guys, send it over to us, we can run a customized one directly for your client. So Chuck and his team have worked on some really, really technical ones and found solutions for them. So if we get up to that, 80 to 90%, we know those are really tricky, but Chuck has a lot of different solutions, and his team has a lot of different solutions for that. So let us get a stab at it. Let us try it. You'd be surprised how often we can help find a solution for you guys.
Well, that's wonderful news, and I want to thank you both for taking the time out to be on the call today, and thank you to Prue for all you're doing to help out the customers and the clients and everybody. So with that, I'll close the meeting. And if anybody that's on the call has a question about Prue, be sure to call me or call the sales contact that you have at SMS, and we'll get you taken care of. All right, that concludes the call. Thank you.